Good morning, everyone. Thanks for joining us. I think we still have a few people rolling in as well. See a couple connecting to audio. I'll give it just a second here, but we'll kind of get started. Welcome to session 2, creating financial reports of our 4-part financial essentials for business series. Appreciate you joining us. As always, this wouldn't be possible without the assistance of Eastern Oregon Business Source, Susan Bauer and Nick Nash, and all of their help. Appreciate that. On the call today, we have our advising team from the Small Business Development Center. My name's Eric Delary. I'm the director. We have with us today Jeff Nelson out of Baker City, Christy Athens, and Lori Skafsma out of Wallowa County. Their information, as well as mine, will be up on a contact slide at some point during this presentation, so don't hesitate to jot down our phone number, emails, reach out to us anytime. We're here to help with anything that you might have questions on as it pertains to anything that you see today, or anything that you have going on in general with your small business. We're here to help you with any advising issues you need assistance with. So without further ado, I will admit these last couple of folks and let Nick take over.
Excellent. Thank you, Eric. I will get everything set up here. Need to enable screen sharing, Eric, or make me a host. So very excited to be here this morning. And hello to everybody who's watching on YouTube, because I know that is also a popular way to work through these presentations. One last step here to get everything set up before we go. All right. Oh, yeah, and of course you end up at the end of your presentation. Sorry about that. All right, there we go. Okay, so I suspect we all realize we're here this morning for creating financial reports. So it's helpful to understand where this fits in with the rest of the sessions in the series, and also recognize that if you weren't able to attend our last session, that's totally okay. We're going to cover some of the same material, and in fact, if you were in our last session, you're going to notice echoes from it throughout. That was intentional. Our hope is that we can introduce some of this information and reintroduce it and get it to stick in your head somewhere. So of course, last time we had financial essentials, which was effectively an overview of various financial reports that could be helpful for your business. Today, we're going to talk about creating those reports, and we're going to include moving them into a spreadsheet program of some kind. Next time, we're going to talk about QuickBooks and move all of the same information into QuickBooks and increase the complexity even a little bit more. And then in our final session on March 24th, we're going to talk about how you can use all of this information to grow your business and find additional funding, something that I'm sure we're all looking for. All right. So, there we go. As Eric mentioned, here is the SBDC advisors. Across the top there, we have their general email address as well as the phone number, and then each of their contact information here. And just to let everybody know, this slide will come up again at the end of the presentation, so you don't have to hurry to jot it down if you're missing pieces. Certainly, as Eric said in the opening, the SBDC is there to support you with all things small business. And if you have any questions about things that come up in the presentation today, your SBDC advisor is an excellent resource to go talk more about it with. All right. And also the company that I work for, Eastern Oregon Business Source, we're located in Pendleton, across from the courthouse. So we live in Eastern Oregon with all the rest of you. We do a variety of things, including business services, community development, and work in the nonprofit and public sector services. One of our favorite things are specialized trainings like this. If that's something that your business is interested in, by all means, reach out to Susan. All right. So a few video conferencing norms. Those who've been in many of these sessions are probably having these burned in our brains, but I find it helpful to start up front. So it's good etiquette to mute yourself when you're not talking. Or one thing that this group has been amazing with is this. If you happen to be using a physical phone, which no one seems to be, it's a good tip to mute yourself on the phone. All of that being said, the session is intended to be interactive. So I think that's one of the great things about this session is that you can interact with myself and the advisors behind the scenes. So if you're in the mood to talk, you can unmute yourself at any time you'd like and speak up. And if you do this, it's okay to interrupt. This is just a part of this kind of presentation. Uh, and I'm sorry, got confused there by admitting someone. You can also type into the chat if you would like, if that's easier for you. And you can click on the reaction buttons and raise your hand. Those are across the bottom. Any of those will come up in my screen and I will call on you. So to get our voices out in the space, I like to begin with a question. And this question is related to the question we asked at this point last week. So on a scale from 1 to 10, how would you rank your confidence generating and understanding financial reports? So one is I am not even always sure how to spell financial reports. And 10 is I am a financial report master. So where are we on this scale, do we think? What do we think? Where are we on the scale from our confidence in generating and understanding reports? Looks like a couple of answers are coming in from the chat. So, okay, 2, -10, 5, 5, 6, 2, 10. Oh, so kidding. Thank you, Christy. I appreciate the joking this morning. I certainly need it. All right, so wherever you are on the spectrum, the goal for this series is to give you the tools to move up the scale a little bit. Okay, so certainly those of you that are 2s or -10s, we'll give you lots of tools to move up. Even those of you that are in the middle, 5 or 6, or wherever you may be, we're hopeful that there are some things that you'll be able to pull from this that will be helpful. The idea is just to move you up a little bit on the scale. So what we're going to do, we're going to review the 7 steps to maximize the value of your business from the Profit Mastery course that was given a little while ago and presumably is going to be given again at some point in the future. This is one of those echoes from the previous session. We're going to look at the most essential financial statements and discuss where you get and put the numbers in those. We're going to interpret what the reports say about your business. We're going to meet a business owner and help her use her financial reports to make a decision. So this session's going to be based around a case study of Lee and her restaurant. And then we're going to review the most important ratios as we go and look at what they tell you about your business with information from our case study. We're also going to look at how just the very basics of how to put this information into a spreadsheet program that you might be interested in using. So, as I promised, the 7 steps to maximize the value of your business. You want to make sure that you plan properly. Planning is probably one of the most important things, and I think also one of the undervalued. You can get a tremendous amount of excellent things out of just making a plan and trying to follow it. It's very important to continue to monitor your financial position. This, of course, is going to be at the center of what we're talking about today. It's important to understand price, volume, cost. You manage your cash flow, something that's tremendously important for all small businesses and something that we will be talking about in our reports. You want to manage your growth. You don't want to grow too fast. You also want to avoid growing too slow. Especially watch out for growing too fast. You don't want to get yourself underwater. You want to make sure that you borrow properly and plan for transitions. All right. And again, this is part of the Profit Mastery course. So if these ideas sound awesome to you, when that opportunity comes up in the future, make sure and jump on it. The feedback from when it was offered previously was excellent, and it is a very good program. All right. So quiz time. All right. True or false? The more customers I have, the more profit I will make. Customers are awesome. So the more I have, the more profit I'll make, right? False. Okay. Anybody else? False. If it's false, why is it false? Does anybody want to type in the chat or unmute themselves and speak out this morning? It doesn't. Oh, depends on one's costs. Excellent. Yes, it is false, right? Sales are made when customers buy things, right? The more the better, certainly, but not just by being a customer. So this image that sort of comes to my mind here is the person who sits in the coffee shop and buys one cup of coffee and drinks it all day, right? Customers are awesome. We definitely want those, but profits come when customers buy things. The balance sheet is the most important of all financial reports. True or false? The balance sheet is the most important of all financial reports. True or false? What do we think? This one that looks like we're not sure. So it's false. The balance sheet, oh, there we go. I would say the cash flow is the most important. Yeah, Christy, I think that cash flow is definitely very, very important. The balance sheet, income statement, and cash flow statements, they're all important. And really, it depends on what it is that you're looking for that will help you choose which you should be paying most attention to. True or false? Current assets are those that will be used up or turned over within 1 year. True. Yes, this is true. It's also true of current liabilities. Current liabilities and current assets are the liabilities and assets that will be used in a year. True or false? The income statement does not cover the period of time between balance sheets. The income statement does not cover the period of time between balance sheets. This one is a little bit of a tricky question. It's false. The income statement shows the revenue and expenses and the profit loss over a specific time period. The balance sheet reports assets and liabilities on a specific date. Okay. All right. So this is another one of those echoes from last time. Our accountant at EOBS pinned our arm behind our back and said that we need to put this in every presentation that we give to small businesses across Eastern Oregon. So these are the top tips from accountants to small business owners. If you remember them from last time, you can shout them out as we go. First, keep your personal and business finances separate. Okay. This is tremendously important. That being said, we're not here to shame you if your personal and business finances aren't separate. Instead, what we're doing is encouraging you to change that. And if after today's presentation, you need some help figuring out the best way to do that, reach out to an SBDC advisor. They're there and ready to help you. Keep track of all expenses along with receipts, documentation, and proof. This is tremendously important when it comes to tax time. Luckily, we live in a time when the future is now, so often we can keep track of this information simply with the click of our cell phone camera if we have a good file management system. 3, it's important to balance your bank accounts every month. This is definitely not the most fun thing to do, but very important, and it's recommended you do it every month. You should use some sort of accounting or record-keeping method or program to categorize and record your transactions. So today we're going to be talking about how to do that using a spreadsheet program, and I'll talk about a few different that you could use. Next time we're going to talk about QuickBooks, increase the complexity a little bit, and then we'll really be rolling. And QuickBooks is definitely an excellent way to do it. But if you're not feeling that your business is ready for that, certainly the methods we will talk about today will work just as well, just a little bit of extra work up front. And finally, don't wait until the last minute to file your taxes. I think good advice for all of us. All right. So I've been promising it all along. We might be wondering, what tools can I use to do what you're going to show us today, Nick? Well, here's a few. You could use Microsoft Excel. You can also use Apple numbers if you happen to have an Apple computer that was made in the last 5 to 7 years. It will have Apple numbers pre-installed on it, if that is your preference. You can also use Google Sheets, which is a completely free option. So any of these spreadsheet programs or any other spreadsheet program you would like. If you like open source options, there's a number of different open source spreadsheet programs, and it will leave it entirely up to you. They all function more or less the same. This being said, if you're wondering which one of these might be better for me to use, if you want to order them from least complex and therefore powerful to most complex and therefore most powerful, if power is what you're after, and maybe you're not, we would order them something like this. So Google Sheets is the least complex and therefore the least powerful, still totally acceptable, very useful for everything we'll do today, but it doesn't have as many features. Apple Numbers is somewhere in the middle, and Microsoft Excel is really the industry standard for this kind of thing. Now, don't tell the Google and Apple people that I presented it this way. I don't want them coming after me, but I think that this is fairly widely accepted. All right. So now I'm going to just kind of quickly go over what these different options might look like so that if you dig into them a little bit, you've at least seen what you're going to see before we get into this. All right. So Google Sheets, we'll start there. If you're at your Google, if you go to Google and you logged in, you have a Google account. If you don't, you need to set up a Google account. It's free. Once you're all logged in, you click here. It opens this window. Scroll down a little bit. There is Sheets right there. When we click on it, we get something like this. We can either make a new sheet or we can click on our sample balance sheet here. If we click on the blank document, we'll be met with something like this. And we're going to be using Google Sheets as our model today, just because it's readily available and free. And I think fairly easy to use, fairly intuitive. That being said, the process should be more or less the same in the other programs, especially Excel. Now, if you want to do the same in Apple numbers, you find wherever it is on your Apple computer, and you'll be met with a screen like this, somewhat different than Google Sheets and Excel. It has its own peculiarities. If this is what you want to use, totally acceptable. I'll leave it to you to figure out the details. Similarly, if we go to Excel, we're going to see something like we saw in Google Sheets. Lots of extra buttons, lots of really cool things you can do. Excel is an amazing program. Certainly much more power than what we're going to need today, but will totally do all of the work that we're going to be asking. All right. So I'm going to ask if there's any questions so far, and then also ask if you've used a spreadsheet program to keep track of your business finances. What program was it that you used? Numbers. Excellent. All right. Excel. Very good. Excel, Excel. All right. I'm glad to see we have the spread. Red Wing. I am unfamiliar with Red Wing, but I'm sure that it obviously works just as well. Thank you all for the input. All right. So now we're going to introduce our case study. So we're going to meet Lee. Lee owns a small restaurant with 12 tables, seating for up to 40 people. She has 8 employees, one of which is a cook. And Lee has been in business for 3 years and is looking to expand to have double the amount of seating. And I'm going to just pause here before we jump into the numbers. And I'm just going to say something about the particular numbers we used. To be clear, the intention here is that these are a model. We kept them fairly simple. That being said, I'm not so sure that they're particularly representative of a restaurant. So keep that in mind. The idea is to give us numbers to work with and think about, not to perfectly accurately represent the real life of a restaurant. So just know that as we dig in, one of the things that's going to become very clear, I suspect, is that our restaurant is wildly, wildly successful for restaurants. The point is the model, not so much the very minute details. So please keep that in mind for my well-being as we move forward. But why should Lee care about the numbers? Well, one reason is that it'll allow her to better understand how hard she's working and the money that she's making for the work that she's doing. It'll also allow her to be more presentable to a lender. Okay. It will make her tax reporting easier and more accurate, and her CPA will certainly appreciate it. It'll allow her to compare her business with similar businesses in the area or across the country. It'll show credit worthiness to a bank or credit card company or an investor. And if she wants to use either of these or take out a loan to help fund her expansion, it's important for her to know the numbers of, behind her business so that she can make a credible application for this. And in addition, it's important for her to know the numbers so that she can have some idea of the profitability of her business if she ever wants to sell it. All right. Now, how will these financial statements help Lee make these decisions? Well, Lee will better understand where she is financially and the direction her business is heading by carefully putting together these financial statements and monitoring them. She'll also have information to share with others, right, such as the bank or potential investors. And she can decide if this is a good time to expand by looking at the debt she has now and the trend of sales over the past few years. And I say this a few times throughout the rest of the presentation. We're only going to be looking at a snapshot of 1 year. When you're doing this for your business, especially if you're expanding, it can be tremendously valuable to look at information across years and compare it and think about why the changes were happening. Certainly in the version of the world we have now, we can think of all kinds of reasons why profits may be down or up depending on what we're up to. All right. So the 3 financial reports that we're going to look at are the balance sheet, the income statement, and the cash flow statement. So these are the same 3 we talked about last time. Now we're going to go into them in a little bit more detail, although, as I said, still very much just as a model. All right. So if we're wondering what a balance sheet is, a balance sheet's a statement of assets and future benefits and claims on them. It's just a snapshot in time. It just records the moment that it's capturing. And we'll remember that assets equal liabilities plus owner's equity. All right. So what does a balance sheet do then? Well, a balance sheet shows your assets, or what it is you own, and your liabilities. These are the things that you owe. Lee's assets include things like petty cash, as we'll see, cash in the bank, accounts receivable, equipment, furniture, food ingredients, drink ingredients, and supplies, things that she owns. Her liabilities will include things like her accounts payable, money she owes to people, sales tax, income tax, a short-term loan that she's taken out, and any balance on her credit cards. And Lee's total assets are her total liabilities plus any owner's equity. All right. So here is an overview of our balance sheet. So we see, as I said, petty cash, $2,500, cash in the bank, accounts receivable, equipment, furniture, food ingredients, drink ingredients, supplies. We add all those up and we get $225,000, 225.5. And when you're applying this to your business, which is what we should be thinking about now, right? What you want to do when you're figuring out your assets is figure out the things that you own. All right. And certainly, depending on the nature of your business, this list could be shorter or longer. All right. Moving on to the liabilities, the things that you owe. So, accounts payable. This could very well include any labor costs that Lee has that are outstanding that haven't been paid yet for the month, sales tax, income tax, a short-term loan that she's taken out, and any standing balance on her credit cards. All right, when we add that up, we get $63,000 and total assets minus total liabilities. We end up with the total equity, 162.5. All right. Now, if we want to put this into our Google Sheets and sort of see how the numbers relate to each other, we'll have an opportunity to do that now. Here, I've moved it all in to our Google Sheet, right? And we can see sort of the wonder of working with a program like this. If we start with our total assets number here, the one that we want, we might think we just need to add these all up with a calculator, and that's how you get here. But no, you can have the spreadsheet added up, of course. Here we see the command equal sum parentheses, and then we can just click on these boxes, and B2 to B9, it will give us the total. And if we set it up right, when these numbers change, this number will change as well. Of course, the wonder of this. To no one's surprise, total liabilities are the list of liabilities added together. And we see it in parentheses there because it is a negative number. And then when we are figuring our total equity, it is our total assets plus our total liabilities plus any carryover equity, which in this case, we don't have any, just to keep things simple. So assets, liabilities together. And here, I'll just point out a tip. You want to make sure that even though this is a negative number, that you're adding it, because if you subtract it, you get double negatives and it ends up adding it in any way, right? So for those of you who maybe you're like me and you're not an expert at math, don't let that trick you. You want to add these negative numbers together. And if you do that, there you go. And again, the beauty of using something like this is that as these change, these total numbers change as well. One very quick tip about Google Sheets that I will just bring our attention to here. You may wonder how it is I got the numbers to set themselves up like that. If we click on Format, then we click on Number, then we can see all of these different ways that we can have the numbers represent themselves depending on what it is that we're doing. I chose financial because I think it's the cleanest and it's consistent with what we're up to today. But certainly, I encourage you to choose whichever option speaks to you the most. It doesn't necessarily matter how you present the numbers, just that you are recording them. All right. So here, I'm going to open it up and ask, what does Lee's balance sheet tell us about her business? And if you're in the mood, you can certainly unmute yourself and let us know, or type into the chat. So what does this balance sheet tell us about Lee's business? Could be hard to say. She is in good standing. Yes, that does seem clear. Why might we think that? Well, her equity for this year is $162,000. That seems fantastic. Her liabilities are much lower than her assets. That seems good. I see we have she owns more than she owes, and that is good. Yes, that is good. All right. So there's a few different tools we can use to dig a little bit more deeply into this information. If we remember the previous presentation, we talked about ratios, and ratios are one of the tools we can use to have a little bit more insight into what is going on. So it's ratio time, my favorite time of the day. All right. So the debt to equity ratio, man, what is that? Well, the debt to equity ratio measures the amount of debt a business has compared to what it owes, right? Debt to equity. Awesome. To figure this out, it's total liabilities divided by total equity, and this is the debt to equity ratio. Nick, you're using a lot of words. What are you talking about? Well, total liabilities divided by total equity. And we can just put these even in our spreadsheet if this is something we want to keep track of. So in Lee's case, that's $63,000 divided by 162.5, and we get 0.39, or 39% of each dollar of equity is debt. So a debt to equity ratio of less than 1 is good, and Lee's is quite a bit less than 1. So that's awesome. However, as the debt to equity approaches 2, banks consider this to be a little risky because it means that much of what the business has is being paid for by debt. Certainly, this can change depending on what your particular industry is. All right. Now, the current ratio, another ratio we can use to make sense of what's going on here. The current ratio is a measure of liquidity, or how fast a business could pay off its short-term debt if it had to. If it's in a situation where suddenly all of its debt comes due, how likely is it going to be able to pay it off? All right, here it's total assets divided by total liabilities. Again, if we return to our documents, total assets divided by total liabilities. All right, okay. So for Lee, this is 225.5 divided by 63, and we get a ratio of 3.5. So Lee has 3.5 more times the assets than debt. And this is considered high or good for any business because it shows that the debt is low compared to the assets. So therefore, the short-term debt could be paid off very quickly if necessary. Creditors like to see this ratio somewhere between 1 and 2. So Lee's business is considered liquid and financially solvent, at least in the short run. All right. So that was a wild amount of information, and it probably came at us all pretty quickly. So I'm just going to pause and ask if there's any questions or comments about any of that before we move on to income statements. Okay. All right. Income statements. So an income statement is a statement that reports revenue, right? Money earned and received, and expenses, or money spent to do business. It shows total income and expenses over a period of time, right? Whether it's a month, a quarter, or a year. Our example today is going to show a year. And revenue minus expenses equals our profit or loss in the case where it's negative. So to better make sense of this, we're going to break the income statement down into 3 parts. All right, we're going to start with cost and expenses. So we see here rent or lease, $12,000. Seems like a sweet deal. Debt payments, $5,000. All right. Payroll, $45,000. Okay. Taxes, $15,000. Food costs, $30,000. Utilities, $8,000 for a total cost of $115,000. This is the moment that I was talking about where we're not critiquing the particular numbers that we use. We're just looking at it as a model to help us understand how the numbers work. I realize these may or may not be consistent with what we could expect for a restaurant. In any case, when we add up our expenses here for Lee's restaurant, we see $115,000. All right. Now, this shows both our fixed and variable costs. So a fixed cost is costs that a business must pay no matter how the business is doing, okay? So examples of fixed costs are things like rent or our lease, and any debt services we have, things that we know are going to come every month, regardless of what we do in our business. Variable costs, on the other hand, are costs that change according to how the business is doing. And variable costs includes, in this case, things like food and drink costs, payroll taxes, and utilities. So we can imagine that the more Lee's restaurant sells, the higher the variable costs are going to be. All right. So we'll just return to our income statement one more time just to take another peek at it. All right. Rent and lease, debt payments, payroll, taxes, food costs, utilities. All right. Variable and fixed, total of $115,000. All right. Moving on to the income and sales, what the business is making. So here we can get a lot of excellence by breaking this down into categories depending on what it is that our business does. So here for Lee, we see food sales and beverage sales, as well as catering and events, and then some gain from the sales of some equipment that she sold. All right. So food, beverage, catering, and events. All right. That's pretty good spread for a restaurant. And we see when we add that with the equipment, we get a total sales of $447,000. So while you're doing this, keep in mind that revenues equal sales or income from food and beverage sales in any way that these sales were made, right? So here, for example, we see food, beverage, catering, and events. The sale or purchase of equipment is to be listed on the income statement, but it's not as part of the general business sales or revenue, right? It's from something extra. So for example, in this case, Lee sold a piece of equipment this year. So the amount received is shown, but it's separate from the food sales. We don't want to run everything together. And note how Lee can see the sales coming from the various ways that she provides service to the customers. And it's important to know, following from this, where it is our money's coming from. So know what it is that you do and how much money it makes and costs you to make it to help you prioritize what it is you're up to. So for example, we see that Lee made $40,000 from efforts beyond the sales made in her restaurant, right? From catering and events. So this may mean if those are particularly profitable areas for Lee, that maybe she should focus even a little bit more time, a little bit more time on those, right? However, if catering and events are a giant headache and $40,000, although certainly a good chunk of money, isn't worth the time and effort that was put into it, she can realize, for what I put into that, $40,000 is pretty good, but not what I need to feel good about it. and she can know to focus away from catering and events and towards food and beverage sales, or similarly, maybe shifting in the other direction, or focusing on both depending on what resources are available. All right. The final part of the income statement, total costs and total sales. When we add those together, because total cost is a negative number, we end up with our profit loss, or in this case, $332,000. All right. If we want to put this into our Google Sheets, here we go. If we want to see how the numbers work, this, of course, is this column added together. Awesome. This one is this column added together. Very good. And this is these two together. It's added because this is a negative number. And there we go with our profit and loss. If this is positive, we made a profit. If it's negative, we lost money. And there we go. When we put it all together, it will look something like this, as we saw in the spreadsheet. So what does this balance sheet tell us about Lee's business? What can we see? She's making a profit. Yes, very profitable. She's doing a great job. Looks pretty good. Yeah, I agree. She made money this year. Good for her. Yes, indeed. It seems like she's doing well. Certainly, we don't know the details of her business, but just looking at the income statement, things look all right. So, our favorite time, ratio time. All right, a couple more ratios that can help us out here. Return on equity. Well, remember that return on equity is a measure of efficiency, and it tells us how much a business spends to make a dollar. It's net income divided by owner's equity. So this requires us to look at a couple different documents. So we'll go to our income statement and go back there. We'll take our profit loss here and we'll go to our balance sheet. We'll take our total equity, our net income divided by owner's equity, 332 divided by 162.5 equals 2. So Lee's equity in the business generates sales of 2 times her equity. We know if this is high or low only by comparing it to the average return on equity among others in the same industry. And you could kind of imagine how this works. If you work in an industry that requires you to invest a tremendous amount of money to make a little bit, this ratio is going to be one thing. If you're in the opposite kind of industry, it could be the other way. There is no set number that we're after. Lee will also need to be careful not to look at this ratio or any other ratio in isolation. Instead, she wants to look at all of them together and over time so that she can get a full picture of where she's at. An average return on equity, vary widely depending upon the industry we're in. Lee can boast about her return on her investment and feel confident that her restaurant was profitable in 2020. I'll be honest, I almost went back and remade all of this so that it wasn't set in 2020 because it's been such a rough year for restaurants. But for whatever reason, last year, Lee's restaurant did excellent. However, what matters most is how the business has done over the past 3 to 5 years, not just 1 year. Certainly, generally speaking, perhaps setting aside things like global pandemics, what we're interested in is the last 3 to 5 years, not one. Comparing the numbers over time shows the direction that the business is heading in. If those numbers are going up, that's really awesome. Even if they're staying consistent, that can probably be pretty good as long as your costs are also staying consistent. If it's going in the negative direction, depending on what's happening in the world, that could be a bad sign. All right, one more ratio, net profit margin. Net profit margin tells us what percentage of every dollar turns into profit. Pretty useful thing to know. Net profit takes either net profit or profit loss, how it's represented on our documents, and net sales or total sales as it's represented, and divides them. So here we have our profit loss there, $332,000, and our total sales, $447,000. And in Lee's case, we get 0.74. So 74% of every dollar in Lee's business turns into profit. This is excellent. I think we could all agree to that. And certainly what we're looking for is the higher, the better, of course, depending on what industry it is that we're in. Net sales is also the same as total revenue. You may see it presented as that. And it tells us what the amount of money earned by the business was during the period without considering its expenses. Net sales, just how much went out the door. Net profit is what's left over after all of the costs are considered. All right, quiz time. So total revenue is shown on the balance sheet. Is this true or false? Does anybody remember? Total revenue is shown on the balance sheet. Does anybody remember? False, false, true? Okay, it's false. Total revenue or sales is reported on the income statement, also known as the profit and loss. Accountants advise small business owners to balance their business accounts on a monthly basis. True or false? This is also the question that asks us if we were paying attention earlier in the presentation. Yes, it's true. And part of the reason is because mistakes are easier to find when they're discovered soon after they happen. I certainly know this is the case at EOBS. It's a lot easier to unwrap things when you discover them quickly rather than 6 months down the line when it could be very hard to fix mistakes. A measure of profitability is a current ratio. Remember how the current ratio works. Is this a measure of profitability? False. The current ratio is a measure of liquidity. Remember that it tells us how quickly we'll be able to pay off our debts. Current assets divided by current liabilities is how we get the current ratio. Okay, about 12 minutes left, right on time. The cash flow statement. So this is a report that shows how cash is used to do business. So a cash flow statement is typically broken down by operations, investing, and financing. So operations are the money that needs to go in and out of our business for us to keep doing business. Investing, as we'll see, involves things like money spent on equipment or any improvements that are done on your location. We're going to see that Lee is very lucky and that her landlord bought her a bunch of shelves, which she's going to be able to take with her, thus adding to her cash flow. Interesting situation. And then financing. This is the cost of borrowing any money that you have borrowed. All right. So our cash flow statement here, something that we haven't seen before. There we go. Our cash beginning balance. In this case, it's from the previous year. Carry forward of $64,000. All right. Our operating cash flows, income from operating activities, $440,000. Expenses, $110,000. And then there was a gain and loss from the sale of the assets. So Lee sold something for a little bit of a loss, which is represented here. So if we have a keen eye, we're going to notice that this number is a little different, 110,000. It's represented slightly differently elsewhere because the debt service is added to it elsewhere. All right. As far as our investing cash flow, there were the leaseholder improvements that I mentioned. Lee's landlord gave her some shelves. Those are recorded as a positive cash flow here. And then there's the proceeds from the sale of the assets. So she sold the machine for $10,000, but there was a $3,000 loss on that. That's reported here. So we see her total investing cash flow is $14,000. And then, of course, the financing cash flow, $5,000. When we add these together, we get our cash ending balance. When we add this, the net cash change to the beginning balance, we get the cash ending balance. All right. So we're going to put this in our Google Sheet. Here we go. We can see this is simple addition. All right. Addition again. Okay. And then we just add these numbers together, remembering to add the negative, and we get our 400,000. And this is these two added together. And there we go. Subtracted. This is the one place where we use a subtraction sign. $400,000 minus $64,000 delivers us with our net cash change. All right. Our cash flow statement. What does this, it's not a balance sheet, it is a cash flow statement. What does the cash flow statement tell us about Lee's business? What do we think? What does the cash flow statement tell us about Lee's business? We can see that she certainly has positive cash flow. Yeah, she has a lot of cash, a lot. It seems awesome, depending on what she is up to. She has plenty of cash to work with moving forward. Now, here I will caution us all. One of the questions we want to ask ourselves certainly is, why do we have so much cash, right? And is it because of conditions that might not happen again, right? We want to compare where we are now to where we've been in the past and contextualize it with what is happening in the world so that we can figure out, is this something that's likely to continue? If we think so, then certainly maybe we want to spend some of our cash on the expansion that we're thinking about. If not, then maybe we want to be careful and set it aside for a rainy day. It just depends, but it's important to contextualize the numbers. So we saw that selling a piece of equipment, right, brings money into the business. So it was shown as an inflow of cash, and the loss or gain is reported under operating cash flows. It was a loss, so it's shown as a decrease or outflow of cash because the equipment was sold for less than it was paid for. Lee's sales exceeded her obligations by $325,000. And when considering the sale of an asset, an improvement to the space, and the loss of the sales of the equipment, there was a net change in cash of $336,000. So note, the beginning cash balance was the total amount of money in the accounts at the end of the previous year. And the net change in cash, shown on the cash flow statement, shows the flow of cash through the business in 2020. This was a strong sales year for Lee, so she has extra cash, and she can use this to pay off debt, or she can take it out of equity if she wants. And the surplus will be favored by the bank if she decides to apply for financing for her expansion. And again, this being said, it also matters what happened in the previous years. So remember that Lee's been open for 3 years. If she goes to the bank and asks for a loan, the bank isn't going to only be interested in what happened this year. They'll also be interested in previous years, and that will matter as well, right? We want to make sure that this year just wasn't particularly stellar. Certainly a 2020, probably not one that is generally particularly stellar, but maybe it worked out very well for Lee. What we want to do is compare the last 3 to 5 years and see where we're at. All right, so we're almost to the end, but I'm just going to pause and ask if there's any questions or comments about any of this. And I will mention again that if it all was coming very fast, which maybe it was, there is a YouTube video of this going up shortly. that you'll be able to review if you want. And certainly there are the SBDC advisors that are happy to help you. Excellent. Well, thank you. Excellent. Very good. All right. One last thing we're going to cover. This is the break-even point. So how much does Lee have to sell to break even? Something we want to keep in mind. And we can figure out how many customers she needs to serve to accomplish this. So break even is the total fixed costs divided by the total sales minus the total variable costs divided by total sales. Man, so this is a tool to help decision makers, but it doesn't look into the future, something to keep in mind. It only captures a moment of time, right? And if this seems like gibberish, just hang with me. It'll be okay. All right. So total fixed cost divided by total sales minus total variable cost divided by total sales. All right. $17,000 Lee's total fixed costs. Well, remember her rent and her debt servicing. Divided by the total sales, okay, minus the total variable costs. Total variable costs is the remainder of her costs, divided by her total sales. All right. Where we end up is with $21,250. So the break-even point is when Lee reaches an average of $21,250 in sales per month. Above this in a month is profit. So this is what the point of the break-even point is. It tells us how much we need just to be at zero. Everything we make above zero is profit. Anything we make below that is a loss. And this can help us know if we should really even be doing whatever it is we're up to. And Lee can go even one step further. She can figure that the average dollar amount per guest is $25. Now, this number would be something that she would know based on her other record keeping. So paying attention to the receipts and how much the average person sells, she knows that the average amount per guest is $25. Break-even point, $21,250, average sales per month. So this means when we divide these up, that she needs 850 guests per month or 28 guests per day to break even. All right. So I'm going to open it up for questions, but because we're nearing the end of our time, I'm going to also skip forward here to our slide of the SBDC advisors. But I'm going to also ask what was most helpful or interesting to you from today's presentation, and what would you like to learn more about in our next session? Again, here are our sessions, but this is where I want to get to. So again, what was most interesting or helpful, and what would you like to learn more about next time? I will open it up. Excellent. So I certainly, the question was, you mentioned 3 tools for record keeping. Why do you not recommend QuickBooks? So to be clear, certainly we do recommend QuickBooks. In the progression of our series, where we started was just with the essentials. Then we moved into, in this presentation, just talking about creating the reports in spreadsheets, something that everybody would have access to. Next time, we're going to dive into QuickBooks and then growth funding. Certainly, QuickBooks is fantastic, and we encourage everybody to use it. But if you're a little bit unsure, certainly where we want you to start, if you're not doing anything, is with these things. So thank you for the excellent question. All right. Are there any other?
Yeah, we had one more in here from Ariel that I thought was a great question. So I just wanted to point out real quick. She said, if you only have assets and costs, but zero debt, but zero profits and revenue, should you still file taxes for that year's startup cost? And absolutely, you should file taxes for that, even when you're starting your business. If there's expense involved, sometimes that helps offset a little bit of your tax liability. and just something that that would be ideal. And the IRS, Susan pointed out to the IRS wants to know how much money was made or lost when dealing with money and doing transactions. The government requires a tax return. So make sure to file your taxes, and yeah, absolutely include your costs.
Yeah. Thank you, Eric. And I apologize, Ariel, that I missed your question as we were going.
Also, I had a few direct messages just about where we can find these recorded sessions afterwards. So we usually send out an email to remind you of any upcoming sessions that are occurring. But in that email, typically as well, there's a link to our YouTube for the previously recorded session. I've copied both our Facebook link in the chat here, as well as our YouTube link. If you want to go and follow us on Facebook, it'll be posted there and you can find it there. And then if you also subscribe to the YouTube, as soon as we upload a video, you'll get a notification that says we have, and you'll be able to review. And then you can take your time and go back through this, because Nick did a great job covering everything.
All right. Well, thank you all for your time and attention today, and we look forward to seeing you over the next 2 weeks as we dive into QuickBooks and then look into ways to expand and grow. I hope you all have a good day.